In Part B of Chapter 8, we move on to how risk and return are measured for portfolios and the capital asset pricing model. Let's continue with our example using high-tech and collections. Let's consider investing $50,000 in each of high-tech and collections. Finding the expected return of this portfolio is a straightforward weighted average. Portfolio standard deviation is not a weighted average. It's a bit trickier. The expected return on a portfolio is simply the weighted average of the expected returns of the assets in the portfolio. The weights are the percentage of dollars invested in each asset. In our high-tech and collections portfolio, the weights are 50-50. We calculated the expected returns of both assets in Part A. High-tech 9.9, collections 1.2. So the expected return of our portfolio is equal to 0.5 times 9.9 plus 0.5 times 1.2, 5.5. Using the technique on the previous slide assumed we had already calculated the expected return of each of the assets in the portfolio, which we had. There's a slightly different approach which has the advantage of setting up the data to compute the portfolio's standard deviation. In this method, we compute the expected return of the portfolio in each state of the economy and then apply the probabilities. Looking at this method step by step. First, we calculate the return during a recession of a portfolio of 50% high-tech and 50% collections. Then repeat that calculation for each state of the economy. Then we multiply those results times the probabilities and sum the results. That's our portfolio return, same as we found with the first method. Portfolio expected return is fairly simple. Portfolio standard deviation is not a weighted average of the standard deviations of the assets in the portfolio. If it were, there would be little benefit to diversification. This is the formula for the standard deviation of a portfolio. It looks and works in a manner very similar to the formula for a single asset. Again, be aware that this is for use with expectational data, not historical. Probabilities imply expectational. Using historical data requires a slightly different formula. And be careful to follow the order of operations. Calculating the standard deviation and coefficient of variation for our 50-50 portfolio, we find a standard deviation of 4.6% and a CV of 0.84. A 4.6 is much lower than the standard deviation of either stock. Why? Negative correlation. The returns on these two assets move opposite to each other. High-tech is cyclical, collections is counter-cyclical. Placed together in a portfolio, they offset each other. This shows all the steps in finding the portfolio expected return, standard deviation, and coefficient of variation. Find the expected return of 5.5 first. Calculate the deviations. Square the deviations. Multiply the deviations times the probabilities. The sum of these is equal to the variance. Take the square root to find the standard deviation. Coefficient of variation is standard deviation divided by expected return. This table recaps our results for both stocks individually and together in a portfolio. It highlights the significant reduction in risk by combining the two risky stocks into a portfolio. The drastic reduction in risk in our sample portfolio was driven by the strong negative correlation between high-tech and collections. Correlation is a binary metric, meaning, in this case, it measures how the returns on two assets move together or not. Perfect correlation, rho is equal to 1, means the returns move exactly together. The correlation between most stocks is about 35%. That means combining stocks in a portfolio generally reduces risk. If the returns on two assets are perfectly negatively correlated, rho is equal to -1, then the results exactly offset each other, resulting in no risk, the straight line. Ideal? But remember, no risk means no downside, but no upside either. Perfectly positively correlated means no change in the risk profile. Using the average correlation of 35%, you can see in the graphs there is some risk reduction, some contraction of the curve, but some risk still remains. The light blue in the graph is market risk, the risk of being in the market as opposed to investing in the risk-free asset. We'll see that the darker blue is diversifiable risk, risk that can be reduced by diversification. The standard deviation, overall risk of a portfolio, decreases as stocks are added because they would not be perfectly correlated with the existing portfolio. Expected return of the portfolio would remain relatively constant. Eventually, the diversification benefits of adding more stocks dissipate, after about 40 stocks. And for large stock portfolios, risks tend to converge to about 20%. So far, we focused mainly on standalone risk, the risk of holding a single asset in isolation. Standalone risk has two components: market risk or systematic risk that cannot be eliminated by diversification, the light blue on the previous graph. It's measured by beta. Diversifiable or unsystematic risk is risk that can be eliminated by diversification. That's the dark blue on the graph. If an investor chooses to hold a one-stock portfolio, doesn't diversify, the investor will not be compensated for the extra risk they bear. Standalone risk is not important to a well-diversified investor. The well-diversified investor is concerned with the contribution an asset makes to a diversified portfolio. Beta, the metric measuring systematic or market risk, is a central feature of the capital asset pricing model. CAPM was developed in the early 1960s by William Sharpe, 1964, Jack Traynor, 1962, John Lintner, 1965, and John Mosen, 1966. Interestingly, only one of these men, William Sharpe, received the 1990 Nobel Prize in Economics for this work. CAPM links risk with required return. Remember, what we found using a probability distribution was expected return, expected by you. Required return is the return the market demands for the amount of market risk an asset has. CAPM defines a security market line, a linear equation shown on the slide that states that a stock's required return equals the risk-free rate plus a risk premium that reflects the stock's risk after diversification. Conclusion: the relevant riskiness of a stock is its contribution to the riskiness of a well-diversified portfolio. Beta reflects the volatility of a stock's returns versus the volatility of the market. Beta indicates the contribution of an asset to a well-diversified portfolio. By definition, the beta of the market is 1. A beta greater than 1 implies the stock is riskier than the market. Less than 1, less risky. Betas tend to be between 0.5 and 1.5. Beta can be negative, but it would be very rare. We'll see that collections in our sample does have a negative beta by design to make the point about diversification. Recall, the security market line defined by the CAPM equation is a basic linear equation. A negative beta would mean a downward slope to the line. Well-diversified investors are primarily concerned with how a stock is expected to move relative to the market in the future. Without a crystal ball to predict the future, analysts are forced to rely on historical data. A typical approach to estimate beta is to run a regression of the security's past returns against the past returns of the market. The slope of the regression line is defined as the beta coefficient for the security. This graph shows the regression lines for high-tech collections and the Treasury bill. Since the T-bill return doesn't vary, its beta is 0. High-tech's regression line is upward sloping with a slope of 1.31. Collections is downward sloping with a beta of negative 0.5. So now for each of our sample assets, we have expected return and beta. What you can see from this table is that stocks with higher betas tend to have higher returns. So what do we do with the data we now have? We can use the betas for our assets to find their market required returns. With a risk-free rate of 3% and a return on the market of 8%, we have all we need to find the required returns. The market risk premium is the return on the market minus the risk-free rate. The market risk premium is the additional return over the risk-free rate to compensate investors for assuming an average amount of risk. Its size depends on the perceived risk of the stock market and the investor's degree of risk aversion. The risk premium varies from year to year, though estimates suggest a range between 4 and 8% per year. For our sample, the market risk premium is 5%. Using the CAPM SML equation in our given data, we can compute the market required return for each asset in our sample. Now we have two return metrics for each asset. Expected return, expected by us, calculated from a probability distribution. Required return, required by the market. A stock is priced to earn this return. Comparing expected versus required gives us an indication of whether an asset is underpriced, overpriced, or fairly priced. High-tech appears to be undervalued since we think it will return 9.9, but it's priced to return 9.55. Collections appears to be undervalued as well since we think it's going to return 1.2, but it's required to return 0.5. U.S. rubber, however, is overvalued. If we feel good about our expectations, we would buy high-tech and collections and sell U.S. rubber. Plotting these versus the security market line, we see that high-tech and collections plot above the line, while U.S. rubber plots below the line, and the market is on the line. So what will happen? Price pressure from trading will force them all back on the line. The format of the CAPM equation is that of a standard linear equation, y is equal to a plus bx. While the focus has been on solving for the required return, there are occasions where we might need to solve for one of the components on the right-hand side of the equation. This video tutorial demonstrates solving the CAPM equation for each of its component parts: the risk-free rate, the return on the market risk premium, and beta. Additionally, this video serves as a review of solving an equation for a single variable. Notably, CAPM is applicable to an individual asset or to a portfolio. If we have a beta, we can use CAPM. The beta of a portfolio is simply the weighted average of the betas of the assets in the portfolio, with the weights equal to the percent of dollars invested in each asset. In other words, this formula is virtually the same as the expected return on a portfolio. Same weights, different weighted values. Let's work through an example of a portfolio beta calculation. Continuing our sample portfolio of 50% high-tech, 50% collections. High-tech's beta is 1.31, collections beta minus 0.5. So the beta of the portfolio is 0.50 times 1.31 plus 0.50 times minus 0.5 equal to 0.405. We can find the required return on our portfolio in two ways. First, the required return of the portfolio is a weighted average of the required returns on the two assets. Since it's 50-50, it's a simple average. Or we can use the portfolio beta in the CAPM equation. Same answer either way. The security market line is not static. It changes as its components change with market changes. If inflation expectations increase by 3%, but the market risk premium doesn't change, then the security market line shifts up. Inflation expectations increase the risk-free rate, which is the y-axis intercept. If investors' risk aversion increases, but the risk-free rate stays constant, then the line will ratchet up, affecting high beta stocks more than lower beta stocks. CAPM has not been empirically verified, though it has been studied since it was introduced in the 1960s. There are statistical issues with trying to verify it. A main issue is that CAPM is an expectational, an ex-ante model, yet any attempts at verification use historical data, ex post. In addition, there has been a significant amount of research looking at other factors that could influence required return. Chief among this research line is the work of Fama and French, who found that required return is influenced by a firm's market-to-book ratio and market capitalization. If investors are concerned about standalone risk as well as market risk, CAPM may not produce a valid estimate of required return. With all the continued research, CAPM is still the primary model used to depict the relationship between risk and required return. This ends our coverage of risk and rates of return. The formulas for Chapter 8 and Chapter 9 are posted as a PDF with this lesson and with Chapter 9 for reference.